Now, as we closed off the last segment on this chart, wanted to reiterate it because it's important when you consider, some of those underlying pieces that aren't, I don't want to say they aren't captured enough, but, they aren't reflected in the same way when you look at, this is an extra, let's call it, $1,200 that could go to a vacation. I mean, they could go to a travel, it could go to Christmas presents or something. It's just, you get this number that is just blowing up some people's budgets in terms of childcare. It's one of the reasons why you've had that bifurcation between men going back to work versus women, because it's like somebody has to stay home at some point because you're not getting the same level, or you're seeing more women go back part-time. And again, this is for those that heard my joke from the last segment, it'd be pretty nice to only pay $10,600, because I know that at least by me, that would barely get you, 3 months. So there's an issue there in terms of where some of this is, where some of the pressure points are. And this is not something that has gone down recently, and that's going to be an important one to watch as we start looking at services and some of the key components on the global flash US PMI. So US manufacturing came in at 49 versus the estimate of 46.2. So it was less bad, which is a positive, but it's still in contraction. And as we were saying, and for those, because we try to be consistent, we're not here, to give you this doom and gloom, even though sometimes I guess it could sound like this. We've been saying that manufacturing was going to get to a point and then bounce. It's just, we still have, we're still in an okay position. It's not like the world is ending today. It's like we're just going to bounce sideways. It's just going to bounce in contraction. It just be, and one of the things that we were saying, it was going to be between that 48 and, maybe 47 and a half and 49, and just kind of sit there. And that's what we saw here. The biggest area where we see accelerating downside is the service front. It's still in contraction, but it missed estimates. Estimates were 53, came in at 52. And that's where we do see some of that downside, and we do see that going negative. It's just, is it negative in August? Is it negative in September? That's where, shrug emoji. It's something where it will go down. If you looked at some of the leading data and leading consumer data, we would say it is negative. So sustained rise in new export orders for services helps support the upturn as domestic demand lost momentum. Elevated price pressure still led by services, which when you look at, again, the expansion, all primary PMI price indices are in expansion. Again, not something that you see in deflation, not something that you see in disinflation, because now you're going sideways. That's a stagnation. And that's where we see the pressure. That's where we see that accelerated downside, which is why we do see some of those pressure points, because that is not a good thing when you're looking at trying to get in front of inflation, and more kind of support for why we do see or could see another rate hike one more time. Initial flash reading, which again, prices charged moves slightly higher alongside manufacturing input and output. Then when you put this in perspective, you kind of get that harder pivot on the service front. Manufacturing, as we were saying, just kind of bouncing back and forth, but it's going to stay bouncing in a contractionary standpoint, especially when you start looking at business expectations starting to move down, still expanding, but you get an idea that you're getting this coming down on the service front. And then future output on the manufacturing side, a bit of optimism. And why wouldn't you have some optimism after some pretty negative numbers? Now you're starting to get some of this balancing out. And as we've said from the very, very beginning, services and manufacturing had this huge alligator mouth. And our view is that not that services were going to collapse down to meet it, but there was going to be a meet in the middle. It was going to be much closer to no growth, but it was going to be a marriage in the middle, and that's where we continue to see that happening. Manufacturing output slightly expansionary at 50.2, but then when you start looking at some of the regional sides, so Richmond Fed Manufacturing prices received still in positive territory. It's still going back to 2016. At a very elevated level. Richmond Fed Manufacturing Index was expected to be at -10, came in at -9. New orders came in at negative 20. And here's where, again, just kind of sideways. It's not that it's going to keep getting worse. The trend is still down, but again, you're in this channel and it's going to get tighter and then start to flatline, but it's going to flatline in a contractionary standpoint. Inventory levels of finished products surged to 11. So again, people are going to have to work through inventories before they bring that back as prices paid continues to be in expansionary territory. Then when you look at Kansas City Manufacturing Index came in at negative 11 versus the estimate of negative 10. New orders, production, shipments all plunged further into contraction. Work week also fell deeper into contraction. Employment edged slightly higher, while prices paid rose to the highest since May. So you had prices going the highest since May, and then you had all the other leading indicators coming down, which again is just kind of putting a snapshot in time on one piece of the country that is, still continuing to be in a contractionary standpoint. Philly Fed Service Index, on the other side saw prices, it's moving up to 1.4. 6-month outlook looked okay. Kind of that pivot. So you had some negative on the manufacturing side, some kind of flattishness on the Philly service side. Kansas City manufacturing a bit weaker. So here's where, again, you're kind of getting some good news, some bad news, and it just balances out to be in this, slightly expansionary territory because services does weigh more than manufacturing when you start to layer this together. Philly Fed Manufacturing Index expected at negative 10, came at negative 13.5. New orders came in at negative 15.9. So again, that manufacturing side continues to be that pressure point. Manufacturing 6-month business outlook did recover. Expected new orders recovered because, again, you can only be down for so long. Now, the question is, obviously these are expectations. What does 6 months look like? 6 months, you're getting into December. You're getting you're going to capture all of Christmas. So you should see some of that get better. How much of it comes to fruition is going to be an interesting thing in general. Philly Fed Manufacturing expected average work week picked up. Prices received went from negative to positive in a very big straight line. Not a good thing that you want to see when you're trying to fight inflation and trying to bring some of that down. The 6-month forecast price, again, 33.8. So inflation expectations ticked higher per prices paid outlook. Looking at the Philly Fed Manufacturing Index, not a large spike relative to history, but firms continue to expect a move higher in prices over the next 6 months. Non-manufacturing index rose to, again, 1.4 versus the negative 16.6. New orders ticked up, but are still contracting. Sales moved into expansion, and prices paid increased further into expansion. So again, it's that balancing act. We do see this in a negative trend, but not dire. It's not like the world is like, oh, well, things are horrendous. It's just you're getting some of this balancing piece that we continue to talk about. So then when you look at per the July update to Philly Fed Manufacturing Index, employment outlook in the 6 months has improved. Not a great thing when you're trying to get in front of wage inflation because, again, if number of employees are going up, hiring is going to pick back up. And based on the labor markets, you're going to have to pay higher wages, and that's going to be an interesting one to see. And then a rebound in future expectations for manufacturing, but you can see it can be lumpy given kind of where things sit at the moment. Quarterly survey, apartment market tightness. So it's interesting because the apartment market index is actually looser, but yet rents are going up. And that's an interesting kind of backdrop. And this looks at availability versus rent, availability versus what's out there. And that's an interesting kind of backdrop because you should see that getting a bit better. Strong red signal for a recessionary increase in the duration of unemployment. Again, things that they want to look at because it's still very low, and that's what they're trying to get in front of. And the apartment piece is interesting, especially as we go through some of those important components on the real estate side. Housing starts have recovered, but construction on average has been below household formation for over a decade. And that's where you need to see some of that, pivot a bit. And it's that kind of the tale of two markets, huge gap between monthly supply for new and existing single-family homes later remains in a secular downtrend because existing homes, the monthly supply isn't there, but you're still getting new homes coming online, the monthly supply of new homes because if you're in a house, you likely have a mortgage that's under 5%. So are you going to go buy a new home and probably get a mortgage for anywhere between 6.5% to 7% without any drop at this point, or at least a small drop in prices? It's like, well, no, the home price hasn't come down enough to make up for what you would pay on a higher interest rate. So that's where you get this kind of this Texas standoff in terms of where things are. And that's why, housing starts in terms of the long run construction continues to be that hindrance when you look at, getting some of that new volume into the market. A weak rebound in monthly supply as, climbed to 3.1, which is off the low on the existing home sales. And then when you look at the decline in median existing home, single family home prices are starting to reverse a bit. They're still down 1.2% in June, but you're not getting that bigger drop, which is again going to cause the Fed to sit there and say, well, we're not where we need to be. Home prices stopped going down. They're only down 1%. And this is why we were so concerned and we had so many issues with the mortgage-backed securities. The fact that they were buying them for 2 years, essentially. It's like, as stimulus, why are you buying that? Like, where are you seeing people having this issue and again, driving down some of these mortgages, which is, I think now, it's going to take a lot of work to get to where they want to be on the home price front. Existing one-family home sales, year-on-year trend in existing home sales is still deeply negative, but getting less bad, if you want to think of it that way. 18.8% decline in June is in lower end of range going back throughout history and remains consistent with recessionary-like drops. And then looking at the kind of that smooth year-to-date, you can see how we're trending and starting to trend a bit worse. And that's something that we do think accelerates. The apartment list national rent index kind of started to turn over a bit, now firmly in negative year-on-year territory. July, index is falling at nearly the same pace as it did in February of 2021. And we would like to see that, again, drop a bit more because, we are getting new capacity. For those that have been following us, we've been showing 5+ units, the most in history. We took out the 1973 high. So there is new volume coming to market, which should help bring down that rent index because, you watch something to go from flat to up 18%. So now we're just starting to come negative. So net, it's still up and it's still up a lot. And that has to, if we really want to see wages come down and living expenses come down, there's still more work to do. Median year-on-year percent price change for new single-family homes rebounded in June to negative 4%, up from negative 10%. But again, still a lot of wood to chop in order to kind of bring some of these underlying pieces lower. U.S. existing home inventory, again, remaining low because the monthly mortgage payment on existing median price single-family homes percent of disposable income per capita. So when you look at where it would be if people moved, the calculation is looking at an LTV of 80% mortgage. Most people are back in that 2021 level. So it's like, well, it's only 25% of my net worth. But if I were to move, it would go up to 40% because prices have not come down to reflect that interest rate. So it's like, look, I'm staying in this house. And that's why you're seeing that home inventory. So we need more of that new homes, but the new homes were built at very elevated prices. Why? Because wood, labor, windows, glass, tiles, everything that went into it was more expensive. So somebody's going to take a loss. Is it going to be the buyer or the seller, or is there going to be a meet in the middle? And right now, that is the Texas standoff that we see. Zillow rent index, again, showing that decline. And then the national year-over-year HPA for June 2023 was 2.9%, but it's starting to bounce higher. Again, all of these things are just, we're making progress. We're getting there, but we're not there yet. And that's why we see the Fed looking at this saying, look, there's inflation starting to tick back up. On the flexible side, core is still annoyingly sticky. Food's going back up, gasoline's going back up. You're like, wow. And again, why we think that there's going to be some other pressure points. This is looking at that FA house price index, came in at 0.7 versus the estimate of 0.6, fifth consecutive monthly gain, led by strength in Pacific region. New England, only region to see a decline, but comes after a strong increase in April. But then when you look at the S&P CoreLogic 20 City, the index fell. It came in at negative 1.7. But remember, the estimate was 2.35. So again, you're seeing it's bad, but not as bad. Overall index came in at negative 4.6 versus the estimate of negative 10. So you're making progress, and then this puts it into perspective in terms of some of the month over month. You actually had an increase. Again, not a good thing for inflation, not a good thing for CPI. When you look at owner's equivalent, this is something that they want to see stay down and not have this big increase overall. Happened at the FHFA as well, as just, kind of putting apples to apples. So then when you start looking at, again, the new one-family homes sold on annual, the June new home sales came in at negative 2.5% versus the estimate of negative 5%. And then when you look at the MBA purchase index, you can see it's still tracking at the lowest level going back to 2014. New one-family homes sold total came down. We're now below where we were in 2019, 2020, and 2021. U.S. new one-family house monthly supply starting to tick back up. Only time it was higher was in 2022. We will see that continue to grind up. And then the last thing is new homes sold pushed forward the new house sold pushed forward 8 months. Houses under construction starting to meet in the middle. But it's an interesting data point, and one thing that I wanted to highlight in this regard, we're actually seeing an interesting point where homes are selling, they're pending, but then they're not clearing the hurdle and they're not actually getting awarded the mortgage. And that's putting a little bit of a damper on kind of some of these numbers. And just as an example, we have friends that are real estate agents, and they've seen anywhere between 50 to 80% of the homes that were pending not go to final sale because of the mortgage issue. And that's going to be an interesting piece as we go forward to see how does that accelerate. But again, a lot of that data, it's moving in the area of, again, bringing prices down, but it's slow. There's a slog because homes are emotional. People get attached to, well, Billy sold their house for $1 million. My home is nicer, therefore I should be able to sell it for $1.2 million, not $850. It's like, well, Billy also did it when mortgage rates were 4%, not the other. So I think there's a very interesting time in general. But that's what we have here on the U.S. front. In the next segment, we're going to go deeper into Europe and some of the problems there as the recessionary pressures continue to mount.